Hey, before we get started, I want to tell you about some bad actors out there. These are people that are trying to sell you annuities. Annuities just don't make sense for the investor. They make sense for the person selling it to you. They have tremendous commissions. They also make sense for the company who created the annuity. Our advice for most annuities is to stay away, and that's simply because we are approaching financial planning from a fiduciary and fee-only standpoint, meaning that when we look at investments, we're trying to figure out what's best for the client, and most importantly, we don't sell product. People come to us to solve financial questions or problems or help set goals for the future. So when we break all this down, I don't know that in the history of our company we have ever recommended an annuity, simply because we don't have quotas. We don't have sales quotas to meet. Our quota is to make sure that each family that comes to us gets the best financial advice possible. The bad actors out there, a lot of times, are nice people, and you might know them from a church or baseball or something like that. It doesn't mean that they're bad people. It just means that they've drunk the Kool-Aid of their organization to sell products that don't work in the best interest of their clients. So stay away. If you want to learn more, you can go to our website at wiserinvestor.com. At the very bottom of our screen, we have buyer beware of the annuity salesman. To input your email, and you'll download our white paper on why you should avoid annuities. Thanks for listening. Welcome to the Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey.
How's it going?
It's going great. We are now post-Masters Week. None of our picks came out, Matthews.
No, Mickelson wasn't close. Spieth actually had a chance, but it didn't work out for him.
That's true. Yeah. Well, they're happy in Japan. I'm glad somebody's happy.
History was made, so it was good.
So we're rolling into the topic this week of inflation. We've seen a lot of articles floating around about inflation and how they think it's going to be higher, which it's funny. I feel like if you talk to somebody who's over 60 years old, I don't know who that would be, Brad.
I'm raising my hand.
They actually have experienced real inflation. They saw a time period where there were 10% CDs, right?
Mm-hmm.
People under 60, I feel like, don't have a whole lot of concept of what what inflation really is. So I feel like that we have to actually start this segment out on what is inflation and why is it such a bad thing or could be a bad thing.
Well, as defined, inflation is simply the change in prices of goods and services that are bought by your average consumer. So the change in price over time equates to an inflation number that is represented in a percentage. So a 1% inflation rate by the CPI means that 1 year from now, or now versus last year, the price of a basket of goods and services costs 1% more than it did then.
You mentioned the CPI. That's the Consumer Price Index. But to kind of put that into perspective, Casey was mentioning how inflation rates have changed. They spiked in the early 80s. Around 82 was kind of the peak. But from 1973 to 1982, the average was 8.8%. And you saw rates go as high as early 80s up to past 15%. And then the average rate overall since 1914 is actually 3.2%. So it's been leveled out, especially over the last few decades. You saw in the 2000s, the average was 2.6. In the 2010s, 1.8. So it's been coming down. But at some point, that's kind of a big discussion now is where will rates go and most likely go up from there.
So what was it in the 90s? What was the average in the 90s?
Not really sure.
Okay. I thought that was on your...
That's what a cup of coffee was.
Oh, that's what. How much was a cup of coffee in the 90s?
1990, 75 cents. And 70, 25 cents. Now, obviously, $2 plus. Depends if you're buying at Starbucks.
I was about to say,
could
but
be
Starbucks
$7.
wasn't really around as predominantly in the 90s, so that might be skewed.
No, but movie tickets were about $2, and now they're closer to 10 plus. So that kind of gives you an idea. You hear usually about what a bottle of milk or what gas costs, kind of comparing to what rates used to be and the difference in purchasing power today.
Well, when interest rates went to zero after 2001, well, we started down the zero path in 2001. To me, that should have spurred on crazy inflation, but it never did. Right?
Right. The traditional approach to the cause and effect of inflation has changed over the past 20 years. And, I believe it has a correlation to the way we calculate it now and the external influences that are in the economy that didn't exist then. And primarily one is technology. The rate of adoption of technology and the creation of technology has changed the way we buy and the way we sell goods and services in our economy, and has had a downward pressure on costs.
Yeah. Your cable bill gets to be $250 a month, and you say, I'm not going to spend $250 a month on 250 TV channels that are a bunch of stupid reality shows, right? Mm-hmm. And then what do? You end up with YouTube TV or Hulu TV, or you get a relatively cheap internet connection, and now all of a sudden you don't need the cable company anymore. There's been some inflation in the online streaming, if you want live TV. So I think that's the cost is starting to come back up again. But yeah, you can say I don't want to spend more than X amount in entertainment, and today you can figure out how to go do that through multiple platforms.
Well, in a broad sense, that, for example, as technology is adopted into the industrial sector, it increases productivity, okay, without increasing wages. It increases your ability to research and development, to bring products and services to market faster than before. So it's reducing these structural costs in our supply chain to make it cheaper for us to buy and sell these goods and services. One great example, I think, is something that we see. Uber. Uber's a great example. It used to be that the only way that you could get around without your own automobile would be a taxi. Well, being a sole provider, they had a complete cost structure that was not infringed on by any other competition. Uber comes along, and immediately the price of somebody to call up a car, come get them, take them to where they need, the price of that just dropped immediately. So technology in that sense dropped the price through competition.
Yes.
So that will continue to put a downward pressure on inflation. Although there are other things out there that are pushing up inflation now, which we're going to be talking about as we go through this. So it's a push and pull, give and take, relationship in the economy, keeping checks and balances in place.
So the threat really to investors is the cost of living goes up.
Right.
Milk costs more. Replace your automobile costs more. To drive the automobile costs more.
Houses.
Houses. Traveling costs more in general. Airfare, hotels, things of that nature.
Healthcare, obviously, too. We'll talk about that later.
So, for example, I'm on the U.S. Bureau of Labor and Statistics website, and there's an inflation calculator. So let's say in January of 2000, a basket of goods and services cost $1,000. Okay, so what would that cost you today? Now, today that's 21 years later, but how long do we plan for people to retire, Casey?
Forever.
That's right. It seems like we're planning out 30 years.
Right.
So here we're looking at a 21-year scenario. Buying goods and services for $1,000 in January of 2000. In March of 2021, those same goods and services would cost $1,569.18. So in 20 years, it's gone up 50%. And we mentioned that this has been a historically low inflationary period. What did you say, 2.8, something like that in the aughts, the 2000 aughts?
The 2000, 2.6, yeah.
2.6?
But, we're in the mid ones right now. I know March CPI was actually just released at 2.6.
2.6, I saw. That's right.
It's going up. It was 1.7 in February. So, we're beating estimates, and the talks are, maintaining over that 2% range right now.
Yeah.
So over very long periods of time, even low inflation can have a devastating effect on your purchasing power.
I mean, while we're working, typically you'd have pay increases each year, right? So it kind of keeps up with that, theoretically.
Theoretically, too. I mean, Social Security is supposed to have a COLA, cost of living adjustment. There's been some years that it hasn't. So that's another thing that you don't calculate. I think a lot of people think their pensions and their Social Security are going to keep up with inflation, and that's not always the case at all.
Well, there's what the government says inflation is, and then there's what your inflation is, and those are two different numbers sometimes.
Right.
I think.
Well, that's a great example because you go to the grocery store, and who hasn't seen the prices on grocery shelves go sky high? And we're talking about a 1% and 2% inflation that's being officially announced, but we're saying much higher than that. In the stores. I mean, who'd have thought you'd be paying $5 for a box of cornflakes? And has that box gotten larger?
No,
smaller.
Probably less.
That's an amazing thing. There's
right.
two ways to keep this in check: either charge more or get less.
Right.
Pay more or get less, and so we see our proportions, shrinking on the shelves.
That's how they're keeping up with their inflation. They're serving us slightly
that's right.
less.
That's right.
Or maybe the FDA wants us to eat less, and they're trying to trick us into it. Well, I think that from a planning standpoint, we have this covered because in our own financial plans here, we're building in the cost of inflation. So we don't ever ask people, how much do you need in the future, and tell me what that future dollar amount is. We ask people, tell me what you need in the future in today's dollars, right? And we'll go calculate that inflation. Healthcare inflation is a little more wicked in that it's about 5% per year right now.
And people think just because they're on Medicare that's not going to increase, and that's not the case.
No, that's not the case at all.
And that's where we see with people who are kind of doing their own retirement calculations where they get into trouble, where they're planning out over a 30-year period and they're not taking into account both healthcare inflation and overall inflation, and that makes a huge difference over a 30-year period.
Well, I've always said it's easy to retire now. It's hard to stay retired 10 plus years later.
Right.
You start feeling a pinch and wonder why. Well, it's because you didn't take into account $5 cereal, 10, 15 years ago. But that's very easy to do and plan around. You just have to have the right software. There's really nothing online right now. You have all these free retirement calculators. Nothing takes into account inflation. I think the best way to simulate it is when you put in your assumed rate of return. If your rate of return is, you probably should be using any more than 6% for a plan number. You just subtract out what your inflation is. So if your inflation's 2, then use 4. Right? Inflation is 3, use a 3% rate of return.
Yeah, your nominal or your real rate minus inflation.
Exactly. So that'd be the best way to guesstimate it at home. But we have software that's able to do both of those. The other part too, and calculating inflation is what can you do about it? I mean, we talked about technology. We talked about there's consumer choices you can make to help lower the cost of living, obviously, but some things you just can't avoid. So at some point, your retirement has to have inflation built in. Your even your retirement savings. So if you're not retired yet, your retirement savings has to have inflation built in. So let's transition the conversation to how do we protect a portfolio from inflation? What are some techniques that you can do inside a portfolio? Brad, you're all things investments.
Well, there are a number of securities that are designed to do this, as well as different asset classes that have historically, protected against the rate of inflation. A particular security is something called TIPS, Treasury Inflation-Protected Securities, and they're designed to match the rate of inflation through the return that you receive over the lifetime of the security itself. The thing about these is that they're forward-looking. So as a security, the investors who utilize them are trying to project out in the future what inflation will be, and then the price of the security is adjusting now in the here and the now, based upon what the expectation for inflation is in the future. So it is a way to buy into a current environment, hoping that inflation, as an investor, hoping that inflation is greater than the expected inflation rate is in the future. That will help protect a portfolio. It requires a large amount, quite frankly. I mean, if you have a large portfolio, you need to have a large amount in this security in order to do that. So it's just one part of a portfolio way to protect your purchasing power of that portion of the portfolio itself.
Thank you for listening to our podcast. We really appreciate all the feedback we've been getting from our listeners on future topics and the That Boy emails. We really appreciate that. We see listeners growing every single week, and that's fun for us, and we enjoy doing this. If you could take a minute, depending on how you listen to the podcast, if you go to Spotify or Apple Podcast, and you could rate our podcast a 5-star podcast, that'll help us in the rankings. We continue to climb up each week in the number of listeners, as well as the response on the feedback online. And then we've also started a YouTube channel. If you go to YouTube, you type in Wiser Wealth Management, you can find the weekly roundup, which is a video between myself and Brad, or myself and Matthews each week, just talking about some of the various topics that we've seen and some interesting thoughts we might have on those. Again, thank you for listening. Please give us positive feedback online. Help us grow the brand. Thank you. The inflation, so in the bond world, you buy a bond and you're getting a payment. So you get this coupon payment every single month. So if you're getting $100 a month, you can't change that. It's not like a stock where a dividend could be increased or there's a price increase. I mean, bonds prices do move up and down, but at some point they all mature at the par value. So you're getting $100 a month. Inflation doubles. We live in Venezuela. Now it doubles. The $100 a month buys half what it bought the prior month, right? That's why bond portfolios and inflation generally don't mix very well, because those bonds are not going to be able to keep up with the purchasing power. Now, there's ways around that. You can move to shorter term bonds, which means that new bonds that get issued would have a higher interest rate because of inflation. So the shorter term bonds would mature faster. Then you can renew.
That's right. Your reinvestment rate is at the higher rate.
Yeah, yes. So you get the new higher rate. So that's a great way to keep up with it. But that's why you would buy tips in a portfolio. Is the coupon remains the same, but the value of the product would go higher, and this is all set by the government tracking the consumer price index.
Right, and that's, you just mentioned bonds. That's not the ag and other type of bonds like you mentioned, measuring durational bond. This is more apples to apples with the Treasury yields, and if it's going to be higher than that.
Exactly. Yes. Yeah. All right. Commodities. How do we feel about commodities in portfolios? I personally, I don't see commodities as a long-term healthy asset class. I want to invest in long-term healthy asset classes. However, you would have commodities in a portfolio because if there's rapid inflation, right?
They've underperformed for 2 decades plus now, so it's kind of been tough to say that they are. But
these are all the things in commodities. It's your beef, it's your beans, it's your it's your oil.
What's other things too? Like you said, it's food. It's also energy. Oil and gas is considered in there, and other types of metals. So
that's all the stuff that's increasing in value.
It's all encompassing commodities. Yeah.
Yeah. So that's the stuff that's costing us more. Therefore, if you own it, then you're appreciating or benefit of the appreciation of that price. I think, I remember this coming out of the financial crisis. Everyone said, oh, got to add commodities to the portfolios. Inflation's going to be just going through the roof in the next few years. Never happened. In fact, I would argue we were in a deflation period, and the government had to generate things to make it have inflation. Right?
Right.
So in deflation, that's a whole nother podcast, but that's that's a problem too. So they were protecting us from prices going down, which is not necessarily a good thing economically. But it never happened.
Right.
Everyone held short-term bonds for a decade. If we had just bought the normal bond fund, we would have done so much better, probably 3 times better on the bond side. So I feel a little burnt by the whole commodity thing over the years, and I at this point I just say, I have my solution. I'll present that at the end.
Well, commodities are in the index already. So as an index investor, we're investing in commodities through the index itself.
Well, not directly. It's not future contracts.
Well, energies,
the stocks,
steel producers, et cetera, through the stocks, yes, of those companies. Right.
Yeah.
So we're seeing it, in that relationship. But yeah, commodities is one of those things that had a historical relationship to inflation. But it was during a time when the inflation was more correlated to the economy, as it was, without the external influences that we've talked about now. Even technology has increased the ability to extract commodities from the markets, from their natural resource state, and has kept those prices down itself. We grow more beef, we raise greater crops, we have ways to extract,
beef now.
Minerals from the ground, et cetera.
Endless supplies of meatless beef.
There you go. So it's been a difficult run for them. Now, in this quarter, to Matthew's point, energy has gone up 30%. Okay, so gas prices have driven this price of oil, which may or may not have been inflationary,
look how low
but more
we got.
Geopolitical.
Yeah, look how low we got. If you look at gas prices over the last 24 months, though, we're about even, right? We're maybe even on the downside a little bit.
Well, what's interesting is when people think of gas and energy, they're thinking about what they pay at the pump.
Right.
When oil was at 140, we were paying $3 per gallon. Well, oil's still at $60, and we're paying $2.50, $2.60, $2.70 a gallon. So the price of gas has gone up proportionately higher today on that barrel of oil than it did when it was 140.
True.
So if oil does go much higher, I don't know what's going to happen to the price of gasoline. Or the gas companies are just making up for some lost revenues.
You just mentioned oil and the price of futures. That's where I think it gets confusing for a lot of retail investors when they're just trying to figure that out. You look last year when crude oil futures actually went negative, and so that became a big issue, and people were trying to bet on that and trying to figure out what that meant for the commodity and oil industry. But yeah, there's a real difference in energy like oil and gas and the sector overall and the futures markets. So there's a distinction.
So I can have this conversation all day long with clients. How do we protect the portfolio from inflation? And we were just kind of rattling those off before we started recording, and Matthews threw a loop in there. It's always a young guy, right?
Yeah.
Got to switch it up a little bit.
Matthews threw a loop in there. He had a whole nother category for getting through inflation. You want to announce this? I'm embarrassed.
Yeah, so it hasn't really been proven yet, considering the onset of it. But Bitcoin is being said to be a hedge against inflation.
They said it.
The B word.
It's out there.
Exactly. It's everywhere. But just like precious metals with gold or any type of commodities, the whole point of this is there's a limited supply. You're having to mine it, and it's out there. So we haven't had a huge inflation since Bitcoin's been around. So it's kind of tough to say whether it'll keep up with inflation. But just like these other assets we've discussed, that they're saying that Bitcoin will be a hedge against inflation in the future once we get inflation.
I mean, if I lived in Venezuela or almost any third world country for that matter, it makes sense just from a currency fluctuation standpoint.
Yeah, you're having 1,000% inflation there. Where you can't buy anything.
Bitcoin would seem very stable.
Yeah.
Where compared to the U.S. dollar, Bitcoin doesn't seem as stable as the U.S. dollar. But that is interesting. That is interesting. In 2033, I think is when the last Bitcoin supposedly gets mined.
We'll have that discussion and see how that works out then.
So mark that down in your notebook there.
All right.
2033, we'll start tracking Bitcoin versus inflation, the CPI.
CPI versus Bitcoin index.
You know what? this is what I've learned in 20 years. And Brad, you're here with me, I think. I don't know. We're going rogue here off our schedule. Just own common stocks. Common stocks are going to react negatively initially to inflation. But who has the ability to change their pricing? Who has the ability to squeeze where they got to squeeze, right? It's companies. It's
Well, that's the whole point of inflation, is that it allows companies to raise prices in an inflationary period. Now, initially, for common stock itself, it's competing for investors' dollars. So if they can go out and get a higher return on a bond that's thought to be safer, investors may purchase bonds, take money from stocks, lowering the price of stocks. But over time, as these revenues begin to pick up, given the new pricing arrangement that companies have, stocks become attractive again. Investors start pouring money back into them. Prices go back up. So there's a little bit of a movement that occurs. And also the secondary effect that when you're a common stock investor is you get the dividend. And in an inflationary period, the same thing occurs. Prices may drop slightly in stocks, but over time, given increased revenues, post-inflationary periods see rise in dividends. So rising dividends offset inflation as well. You mentioned earlier that when investors buy bonds, it is a fixed rate. Common stock dividends that are declared by the board of directors are increasing. There's a group of stocks out there called the S&P Dividend Aristocrats. They've raised prices for over 20 years consecutively. These are companies that raise that dividend year after year after year after year, which has the effect of offsetting your purchasing power of inflation.
right.
So common stock is a great place to offset inflation.
So our only risk is the Fed gets it totally wrong. We see a 6-7% spike all of a sudden, and tips would benefit you from that in that scenario. But otherwise, the steady growth of dividends and the price increase in stock market is more than enough to keep up with inflation. So really the people that have the biggest risk would be the most conservative investors who maybe only have 20 or 30% of their total assets in the stock market. But for the rest of us who are saving for retirement or even have a 60-40 allocation in retirement, it's really not as big of a deal because it just kind of takes care of itself. You shouldn't be buying any additional products for your portfolio. We're looking at tips even over the last 10 years. There hasn't been any bright spot there. You've been waiting for inflation, but it hasn't really done much for you, right? Now, if we get real inflation, maybe there's a spike, but I just think keeping the portfolio conservative, the bond side very conservative, short maturity, and then focusing on the growth stocks, you're fine.
Right. And you keep in mind that there's also we have another player here, and that's the Federal Reserve, and their stated goal is to not allow inflation to rise much above 2%. Now that's a little bit of a fungible number right now. But if it begins to rise, and you mentioned 3, 4, 5, 6%, they have tools in their toolbox to combat that and bring inflationary pressures back downward. So
that's the part that I'm telling you that I don't have a whole lot of faith that they'll get it right, at least the first time. So there's going to be some volatility during that time period, but you just ride through that volatility.
Right.
You're not going to jump ship. You're not going to sell stocks because of inflation. That's like selling your car because the gasoline prices are too high and you're going to start walking. It doesn't make any sense, Right.
That's not going to happen. We have a number of issues out there in the marketplace and that are helping keep inflation in check. Now, we've talked about inflation. We've read about it in the newspapers, and it's a very topical subject right now. But as Matthew's mentioned, it's gone from 1.8 to 2.6. These are very small increases overall.
As long as we don't go back to 15%.
That's right.
Gradually, it'll be right.
There's still 10 million people unemployed after the COVID crisis from 2020. That's job market slack, if you will also help to keep down wage pressure, which keeps down inflation as well. So there's a number of structural issues that still exist in the marketplace that will help to keep downward pressure on inflation. So the unemployment rate, we're in a global economy, which means that the supply chain can move around into different parts of the globe to find the lowest costs of labor and production. And again, we'll mention technology that helps to increase production and lower costs. So there's still a number of things out there that are help keeping inflation in check.
Another thing we've kind of forgot to mention would be real estate. Real estate's a hedge against inflation as well. Regardless if it's just individual real estate, I know we believe in a lot of real estate investment trusts through ETFs as well.
Yeah, no, that's a
very
very good point.
Yes, exactly.
Yeah, we deploy real estate in our portfolios, but yeah, just real estate in general though has people say I can make much more money in real estate, and real estate forces you to be a good investor. Not necessarily the real estate investment trust, because you can liquidate those overnight, but think about just buying rental properties or buying commercial properties. If all of a sudden there's a change in the market, you don't see people going, "Oh, I gotta sell. This thing lost $50,000 in value last year. I gotta sell it." Well, there's a process to that. There's also a 6% commission that goes along with that. But there's a process of people have better behavior with real estate. That's why they tend to think they make more money in real estate, because they can't panic and sell and do things based on emotion.
They only look at the values when they want to.
Exactly.
You're not checking it constantly.
Right. And you get that. You have that rental check coming in, and they see that check. Large cap investing can be very much the same way. People just can pull the plug a lot easier than buying actual real estate. So, all right, guys. Anything else to add to this wonderful inflation conversation? What we're not going to have here is an inflation of time. We try to keep all of our podcasts around 30 minutes for our listeners, and we're at 28 right now. So we'll say goodbye, and we'll see you next week.
Sounds great.
Thank you.
Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.